My name's Chris Gosselin from Australian Fund Monitors, and today I'm joined again by Richard Brennan, Strategy Ambassador at East Coast Capital Management, to talk about commodity markets. Richard, welcome.
Welcome, Chris. Great to be here.
Richard, I'd like to start firstly by saying congratulations on your flagship fund, the ECCM Systematic Trend Fund, which won the Best Global Macro and Managed Futures Fund for 2024 at the recent Australian Alternative Investment Awards.
Well, thanks very much, Chris. We were delighted to win the award and really enjoyed the event. So as a boutique manager, it was great to be recognised for our performance in this forum against many larger fund managers. And it was very fitting to have the award sponsored by the CME Group for our category.
Richard, speaking of performance, your fund delivered almost 24% this year to date and around 16.6% per annum over the last almost 5-year track record. In that time, we've seen some fairly complex market conditions. Indeed, we're seeing more turbulence at the moment with a new administration in the US next year, geopolitical hotspots globally, mixed economic data, and uncertainty over rate cuts both here and in the US. Your fund follows systematic strategies. How does that help navigate that uncertainty?
So, Chris, trend following is an attractive investment strategy due to its elegance in capturing market movements. And the strategy is based on a simple premise: buy when prices are rising and sell when they are falling. This objectivity helps us remove emotional biases from the investment decision. So in times of uncertainty, where emotional reactions can cloud judgment, trend following provides a systematic method to navigate the environment. So when other strategies can struggle with the noise of unpredictable conditions, trend following strategies have clear parameters to capitalise on market movements, whether they be in existing strong trends or emerging opportunities.
Richard, I understand there's a lot of data on trend following over long periods of time, including academic research. Can you provide some colour on these findings?
Yes, there are a number of academic papers looking at trend following across different market regimes, in some cases looking at data over 150 years. And these studies find that trend following yields positive returns over time, consistently performing across many different regimes, which include, things like the Great Depression, the global financial crisis, and of course, many economic cycles and periods of war. Trends are pervasive in markets, leading to fat tail behaviour and outliers. And trend following systems, also known as time series momentum, perform very well if prices trend. Trend following is known for its ability to perform well in historical bear markets, and most bear markets are protracted in nature, extending over several months. This therefore allows trend following models to adapt to this adjustment in market behaviour and take profitable positions. And as a result, during these protracted periods of equity crisis, for example, trend following models zig when buy and hold models zag.
One of the first things I learnt in markets, Richard, a long time ago was let the trend be your friend. And I think that's probably where you're coming from, is it?
Exactly.
If we look forward, while the jury's still out on where markets go next, I appreciate you're not in the business of forecasting. What do you see ahead? What are the exposures of the fund going forward?
So, global diversification is a priority for us. So we trade 60 underlying futures instruments. So while most market participants like to talk about major markets such as equities and bonds in the US, Europe and Australia, we have the ability to invest in a large universe, providing investment exposure that many investors can't otherwise access, including different global geographies, commodities and currency markets. So some recent strong performers in our investment universe include the Chinese stock market, for example, commodities such as gold, orange juice and rubber. So we enjoy the diversification we see in our portfolio, and we like to think of our process as a dynamic allocation of capital from those markets which aren't trending or performing into those that are. So even if we have a period of uncertainty and volatility in popular high profile markets such as the US or Australian equities or bond market, there are always other instruments we are looking at, sometimes quite quirky ones that few investors have the inability to access.
Richard, it's fair to say there's likely to be further volatility and strongly trending markets given the change in administration and policies in the US, given Trump's recent victory. Will that make any difference to your strategy, or is it just likely to create further opportunities?
Well, our models are always prepared to pivot into trending markets, and given the recent election result, we believe it's likely that we'll see a pronounced decoupling of financial markets, given the likely lower focus placed by the US administration on globalization. So if this scenario unfolds, we have the opinion that significant volatility is going to arise with trending opportunities ahead. That should therefore provide significant opportunities for our very diversified trend following models.
Richard, having won that award last month, as we spoke about at the start of this interview, can you talk a little bit about what you believe are the key factors that led to it?
Yes, I've got a few thoughts on this, Chris. So firstly, we are a boutique manager, so we believe we can be nimble where others can't. Secondly, within the world of trend following, we consider ourselves to be classic trend followers, which is to say we embrace volatility and do not attempt to suppress volatility, as not all volatility is bad. We believe our classic trend following focus, combined with a few proprietary bells and whistles, delivers superior risk-adjusted returns for our investors over the long term and is responsible for our very strong track record to date. So to see how we're performing against our trend following peers, Societe Generale publishes a trend following index called the SG Trend Index, which has delivered returns of about 45% since January 2020, compared to ECCM Systematic Trend Fund, which has delivered 107% over the same period. And for those quant geeks who like statistics, we've got a Jensen's Alpha of 12.4% versus the SG Trend Index and a beta of 0.53 versus the SG Trend Index.
Richard, all sounds very impressive. Some of the quant numbers leave me scratching my head. I'm a bit old for that. But many thanks for your time. Once again, congratulations on the award and best wishes for the future.
Many thanks, Chris.